Okay, welcome to all investor. Welcome to Smart Investing with Philippe. Stay with me for half an hour. We're gonna discuss about the market. We're gonna discuss about what has been the latest news and what I think will happen in the coming months in the market. I mean, what is very important is that we know that the key US equity market indexes, because this is the focus I'm actually giving right now on the US market, has been quite challenging over the past months or 2 months. I mean, we are about minus 7% for the S&P 500. We are about 10% minus for the QQQ, so the Nasdaq 100. For the IWM, we are about 10% or so down. I mean, even more than 10%, probably 15% down from the high on the IWM, so the small cap US equity. And this actually was a bit of a surprise after a huge rally in 2023 and 24. So everybody was expecting that the first half of 2025 will be a continuation of 2024, but it is without expecting the unexpected, and to be honest, I mean, this was pretty much expecting that the correction would happen. I mean, if you look at the valuation, if you look at the earnings estimate, you look at the earning growth estimate for the 2025-26, I mean, everything was showing that everything was overvalued, and then quite a correction needed to be happening in the market to let a lot of the steam out of the market, and then the rally could continue its way up after the correction would happen. So I think what we are seeing right now is, as usual, the market doesn't expect uncertainties. There is a lot of uncertainties in the market, and especially relating to the tariffs. Tariffs can have a lot of impact on unemployment, the growth, and the state of the economy of the US. And I don't know if you have seen the last interview of Donald Trump talking about the tariffs and his strategy about the US economy and so on. So he was actually saying that the US economy is going through a temporary reset. He didn't use the word exactly like this, but he was saying that the US economy was in a transition. So I think this type of word is enough to freak out the market and to let a lot of the speculation and a lot of the fantasy about the huge recession. And also one of the journalists asked him, oh, do you think there will be a recession, or US economy will be in a recession? And he actually declined to answer that. He just said that the US economy is into the transition, and I'm not looking at the market. So my message to you is, don't panic. I mean, it's true, it's very painful to go through a correction of 10 or 15% in the indices, but because if you are invested into single stocks, then the downside might be much more than what the indices are witnessing. You know, it can be like minus 30, 40, 50%. I mean, if you have been investing in the momentum retail stock, then you probably down 50% or 40% on these stocks. I mean, you have the name of Palantir, Tesla, SoFi, MicroStrategy, and you have all these names, you know, highly leveraged like Coinbase, and all the retail like Mara, and I can name a lot of them, and that's not the point of this video. But if you have been playing the game of chasing the momentum and chasing at the high, and we have listened to all the YouTubers or to the moon, you know, this is going to go to 1,500, this and this. I mean, even Bitcoin, you know, if you look at the headlines and you take the YouTubers thumbnail of the last few months, then you will see they were predicting Bitcoin maybe to 200,000, 150,000 by 2025, you know. But you see, the Bitcoin has corrected from 110,000 to 85,000, you know. And this is the volatility of risky asset. When the uncertainty is back in the market, when you have a lot of volatility back into the market, then the downside is also part of the game, and you need to accept to lose in the short term to win in the long term. So what is more important is that you feel reassured that you have invested in the right and strong companies, that you have made a good choice. And what is more important also is that you have a long-term view, a longer term view than just the short-term view that most investors are taking. Most investors that will sell today, they will be the losers. They will be losers. If you sell after 40% down, a Palantir or a Tesla or even another profitable company, then you have taken off the steam out of the stocks, and then what you're going to do is you're going to realize your loss, and you're not going to have the chance to recover that loss. Of course, if you have you can offset that loss with a lot of gains, then it's good for you. Then it's part of the strategy to optimize your tax return. But if not, then you should just hold the stocks and just hold it for the long run. I guess that if you wanted to speculate, then it's tough for you, and you've lost that game of speculation. But if you wanted to invest, then just a 1 or 2 months volatility. If you look back at the charts in 2020, if you look at the chart during the coronavirus, then the downside was quite impressive. But if you hold on even 1 or 2 months or 3 months, then you see all that massive loss that happened in March recovered the next 2 months. I mean, you see what I mean? So if you sold at the low of March because you panicked, then it's all gone. And then after that, you have the huge epic rally from the low of March 2020 to today. So you see, it's all about the long term and the perspective of the market. If you are confident of what you invest, then you should stay in your investment. Of course, if you invested the money that you need right now, then this is a mistake you have done. But if you don't need the money for the next 3 years, 5 years, then it's okay. You can just leave the money where it is. And if you have the dry powder to top up your investment when the market has settled, and then you feel a bit more confident, then we are reaching a bottom, then you should top up your investment. This is the best strategy. I mean, the best investment are done during the market crash or the market correction of minus 15-20%. So far, the Max 7 have corrected on average about 20%. I am invested in Max 7 and I've lost 20% from the top. But am I selling? No, of course, they are the 7 strongest company in the world. Why did that change from last year, And why is it going to change from next year, or maybe in 2 years or 3 years? There will be a lot of challenge for NVIDIA and Tesla. Don't underestimate these two companies. These two companies are not as strong as all the other Max 7 stocks. But if you have only 2 stocks out of 7 that are struggling, you can just buy the basket. One day or another, NVIDIA will come back, and then Tesla the same. NVIDIA. Let's talk about NVIDIA. The NVIDIA is nothing wrong with the balance sheet. The balance sheet, I can show it to you right now. It's a A grade balance sheet. Everything is good, but the only problem with NVIDIA is that the growth of the revenue are slowing down. The growth of the net income are slowing down. Still good, but slowing down. And you see the cost of goods sold increased faster than the growth of revenue, which actually means that the margins is contracting, and we have seen it in the margin numbers that it is contracting. So what you can expect with NVIDIA is a decelerating growth stories and contracting growth stories over 25, 26, 27. So don't expect these stocks to do phenomenally good like it did the past 2 years. The past 2 years is a done deal. It's finished, it's over. You need to move on to stocks with better potential, better upside potential. To my opinion, there are a lot of stocks who have the same type of potential than NVIDIA, but you need to take advantage of the fact that the market are not favoring these stocks at the moment. And one of them is AMD. I mean, look at the balance sheet of AMD. This is all pointing to the right direction. This is a highly profitable company. The stock is actually back to the level it was almost at the exit of the crash of 2022. I mean, it's just slightly above that bottom of 2022, But actually, if you look at the Fibonacci retracement level from the rally from the low of 2022 of AMD to where it is right now is exactly on 0.78 retracement level of Fibonacci, and usually this is a strong point to head or to start investing in a stock if you believe the fundamentals are still good and are even better than when it was in 2022. So you see, there are a lot of opportunity during a market crash, a market correction, but you need to have the cash and you need to have the strategy to invest. Of course, I'm like everybody, I'm actually losing money from the top that I was like 2 months ago. But what do I care, you know? I can add when I feel like the market is bottoming up. I can add to my existing investment, or I can buy the stock that I thought was too expensive like 2 months ago. And now it's a more palatable price to buy the stocks for the long term. Do you see? I don't need the money in the next 2 months, 3 months, 6 months, 1 year, or even 2 years or 3 years. I can wait. And the market is a waiting game. I mean, if you expect the Nasdaq to do nothing in the next 3 years, I mean like no return at all for the next 3 years. Did it really happen in the past, except in the 2000? It never really happened. It always recovered. At least in the next years, if there is a crash, the crash of 2022, the most recent crash, it took 1 year to fully recover that crash. 1 year only. So if you cannot wait 1 year, that means you cannot afford to invest in the market. So don't invest in the market. Invest in something else that is guaranteeing your capital, and then you have a bit of upside, and that's it. But even in the bond market, a lot of people say bond market, you know, invest in treasury, there is no risk and so on. But look at the long dated treasury. Look at the swing and the volatility in this type of instrument. You have a lot of volatility. So the mass understanding of the false narrative that bond is safe. I mean, it's quite laughable, you know. Bond is not safe. It's safe if you invest in short dated treasuries like 3 to 6 months, or less than 3 months. Now is about 4.5%. Of course, this one I have no volatility at all. You get your 4.5%, 6%. 4.5%. And that's it. Of course, there is no volatility. But if you invest in 10 years or 20 years treasury, you get the duration risk and you have the volatility relating to this duration risk. And then you can see that the long dated rate does not move the same way as the short dated rate. And a lot of investors, they are suffering a lot since the Fed started to decrease rate back 1 year ago. Remember, they started to announce that they're going to start to decrease rate, and then from there the market just rallied. But the bond market, we expected the bond market also to rally, because when rates usually decrease, then the bond market go up. But it didn't happen, because the long dated rate actually changed quite with a lot of volatility. So the TLT also just changed with a lot of volatility, and it's still doing it today. So even the bond is not so safe, you know. Sometimes it's correlated to the equity market, especially during a crash. So you know, you need to learn you need to do your homework, and you need to learn your lesson about the market, especially if you are beginners and you've never really invested in the market before, and then you are panicking about this retracement or this correction. I mean, you need to be confident. You need to believe in the long term of the equity market. The equity market in the long run is not gonna disappoint you, you know. And just do the exercise. I'm going to show you a chart on TradeView. The chart is showing the return from from the high of 2022 before the crash to today. I mean, it's about like the last 3 years. The last 3 years, the Nasdaq has only returned the year of 2024, which is about 22%. So basically, over the last 3 years on the Nasdaq, if you were invested in 2022 before the market crash to today, you only return about 20%. If you invested just a bit below the market crash because you think was a normal correction, you probably 30%, but 30%, 22%, 24% from the QQQ is not an extraordinary return. I mean, people are talking about extraordinary return because they have been lucky to time the market quite good when the market was actually reaching a bottom, and they were smart enough to invest in companies like Facebook, Netflix, Amazon, or NVIDIA, for example. I mean, they or even Tesla. Then they made a huge rally and they enjoyed several 100% of return. But most investors didn't do that. So it's all depends your personal circumstances and where did you buy the stocks, and if you were lucky enough to time properly the market. But who time properly the market? You know, who? Very, very few, you know, can do that. And if you hear a lot of people on YouTube telling you do this, do that, do this, do that, they don't know what the market will do in the next 2 to 3 months. They don't know. Even next week they don't know. So let them talk. Understand what they are saying. Just take their view, because it's interesting to get a view of a lot of YouTubers and a lot of people who have been in the market for the long time. But don't go for the hype and the fear. The hype is as dangerous as the fear. The fear of missing out is also the same danger as the fear of panicking. If you panic sell, you lose. If you FOMO, you lose. So just do your homework, go to the balance sheet, see if the company is profitable or not, if the earnings and the cash, and listen to the earning call. Just make sure you make your homework to understand the positioning of the company, the product, what is the prospect of the company over the next 3 to 5 years. And then if you have an horizon of 3 to 5 years, even if you invest in a basket of stock like the QQQ, your probability you're going to have 0 return and a negative return is almost quasi 0. Do a rolling 5 years return on QQQ. It's very difficult to lose. I don't say maybe you have one occasion you would lose by a few percentage points, but these are exceptions of losing. And if you look at the future, and would you not bet on the technology sector? Over the past 10 years, the technology sector was a winner bet. Don't you think that the next 10 years, technology will not continue to dominate the economy of the developed nation? Don't you think that the AI and all this new technology around AI and the infrastructure, data center, and all these things will not dramatically change the developed economy or the world economy the same way as internet did in the past? Even much more than that, because AI can impact all sectors together, because the AI will make everything more efficient, more productive. Productivity will make a huge jump, because you don't need one person to do the job of 3. You will need just one person to do the job of 3 or 5. Even myself, I use AI every day. I can do stuff much faster than I used to do before, and I can do a lot of repetitive tasks, and I can do a grossing up of a lot of the tasks so much faster. So imagine in a big office, in a big company, everybody has an AI agent and can do stuff or assistant job for them, or just imagine the potential for increasing the productivity. Even doing the balance sheet crunching or the cash flow, discounted cash flow analysis, AI can do that today. There is no secret for ChatGPT or any other AI that you would buy and you would subscribe to today. I mean, I've done it hundreds of times for many different companies. Just crunch the balance sheet, show me the key trend, on the key data, just do some scenario analysis, worst case, best case, and best case scenario, calculate the cash flow, discounted cash flow, on whether it's EBITDA or whether it's on a free cash flow, whatever method you're going to use to have your valuation, and on different level of discounted rate, you know. and different assumption of growth rate. These are the tools that you can use to do your homework, and AI can do that faster than you can ever do even with Excel. So I know it's a very tough time, and even myself, I don't like when I see red in my portfolio, but you have to get used to the red in your portfolio in order for you to enjoy the green in your portfolio. I never met somebody who always win in the stock market. That means like when the market goes down, he knows in advance, then he's short ahead the market, then he's green. Then when the markets bottom out, then suddenly he closes all his short position, then now go long and leverage everything and just go massively up with the market again. I mean, these people, they probably exist, but I've never heard of them, I've never met them in the last 25 years of my career. I never met them. And I've worked for many renowned fund managers managing like billions and billions and billions and billions and billions of dollars. I've never met them. And most of the managers you invest to, they closely track the index. Their tracking error is very small. They cannot deviate massively from the index weight and the constituent of the index. You will have to go for an unconstrained and a fund that is not regulated by UCITS, because UCITS has a lot of restriction on the investment limit you can put into stocks, and how many stocks you can have in your portfolio, what will be the leverage in that portfolio, the level of cash, what type of option and derivative you can use in this portfolio. UCITS is very constrained. A fund manager, they have to work within that framework of constrained investment. And the nibbling and all the funds that can do whatever they want, they are not UCITS certified, They are probably unregulated or lowly regulated funds. Oh, you do like Warren Buffett? I hear a lot of people talking about Warren Buffett cash level, the highest since the last crisis, and so on and so on. But what they don't understand is what they do with the cash. Warren Buffett is not just holding cash and treasury and that's it. He's using a lot of option strategies. So the cash he has on his balance sheet is offset with a lot of put selling or call selling. He is doing a lot of that. So he's generating a lot of income with this cash collateral he's having on a lot of option position. So all this cash is not just 4.5% treasury and that's it. Is getting a lot more return from this cash level. Otherwise it's not worth it, because you're paying the PE of 30 or 35 times for I don't know how many hundred billions of cash in his portfolio. This is a ripoff. So this is not what they do. With the type of return they have, with all the cash they have, is because they use a lot of option strategies. If you have traded options in yourself, you will know that you can sell put and calls, and this is generating income for you, and then without using your cash. The cash is staying in your account as a collateral for guaranteeing the trade. But it's not disappearing from your account because you have an option position open and with the cash as collateral, So you have to understand exactly why these investment firm and these investors are having also a lot of cash. This cash is not dead; it's working. So what else we can talk as well with this open out conversation about the market? We can talk about the fact that probably the market will continue to go down. What Donald Trump has said during the weekend, that the US economy is going through a transition, is probably going to sink in and is going to scare a lot of people. So before I was expecting the market to bottom from this level, because all of them has reached the 200 moving average. But after Donald Trump has said, and he said that he doesn't look at the stock market, and then he didn't want to rule out a recession. Actually, he just didn't answer the question from a journalist talking about a recession. But the market will take it as if it doesn't rule out a recession. I know how the market works. They always want to make a big deal of nothing. They want to interpret and play with the fear of people. And a lot of the mainstream media on the economic channel, they want to scare a retail investor. They want to scare everybody from the stock, because they want their friend on Wall Street to buy it cheaper. So it's up to you, if you believe that you've made the right investment in strong stock, not to sell them to them. Do you know? You have to hold your whole long-term holdings, and just to withstand the volatility and the storm. I mean, it's like if you are in the middle of the sea and you are sailing with only a wind sail, and you have no choice. You are in the middle of the ocean. It's not because now suddenly there is a storm, you're in the middle of the ocean and you have your boat that is rocked all over the places. Then now you're gonna jump from the boat and just start swimming. Then you are dead. You have no chance to survive. Do you know what I mean? Sorry to use that example, but this is a good example. You are in the middle of the storm in the stock market. If you jump out of your boat of stocks, you are losing. You are dead. You will not come back. You will be scared. And if you come back, you're gonna just realize your loss, and you are never gonna recover the loss. And you're going to buy again and to have that confidence again to come back in the market when the market has also reached another all-time high, and when the confidence and the valuation is also a lot of stress in the market. So this is a losing game that you're gonna play, and the same losing game you're gonna play is the same example as this. If you jump out of your boat during a storm, then there is no chance for you to survive and to ride the wave. You have to fight. You have to fight your fear. And psychology in investing is a very important element to success. Your psychology is going to determine whether you are a winner or you loser. Do you know? You have to be strong in your mind. It's good to do all the legwork, say doing the balance sheet, listening to the call, doing your projection, and so on and so on and so on. But if you don't have the psychology to invest because you are scared for a correction of 20% or 30% or 10% or 15%, that means you have no confidence and you have no conviction in what you do. There's something wrong with what you do, then and if you look back again and again and again in every single correction, or even every single crash, all these companies always come back. As long as they are strong, they can survive through the crisis, through recession and through everything, then they will always come back. It's a matter of time, and sometimes they come back even stronger than it was before the crash. How many times you have a crash and then the market goes slightly and massively over the level before the crash? 2020 is an example, 2022 is an example, 2028 is an example, the 2000 is also another example. There's never been a time in the market when after a huge crash the market didn't even surpass the level before the crash. And the longest it takes to recover was the crash of 2000. But remember, 2000, they didn't have all the tools that the Fed now is using to recover the market as fast as it can. They have this QE, they have this rate to zero, they have to a lot of firepower to prop up the market. And if you listen to the comment of Jerome Powell during the last interview he did on Friday, he said the US economy is in a good shape. He's in a good place. He doesn't see any need to decrease rate anytime soon because it will be too premature to decrease rate again. He doesn't see any problem in the unemployment right now. He doesn't see any problem with inflation, although that the inflation is higher than they want, but they don't see it ticking up a lot. He also acknowledged there are a lot of uncertainty with what Donald Trump is doing. But he didn't say, okay, we are in a panic mood, then we have to go and rush to decrease rate again and again and again. He didn't say that at all. He said the opposite. He feel confident about the U.S. economy. U.S. economy is in a good place right now. Unemployment market is good, and you can see the number on last Friday on BLS. It wasn't a catastrophe. You know, everybody was expecting the maybe in the next following months there will be catastrophic numbers, but so far nothing yet. You know. I know it's very tough. You know. And today it will be tough. There will be a lot of volatility, and if you want to get rich, this is the secret. You have to hold on, and then when the market is really fearful, you know, really fearful that everybody doesn't want to invest, they say no, this is a rigged game, this is crap, and all this, and the people stop and don't want to buy this high leverage instrument like MicroStrategy and 3 times Tesla or 2 times whatever NVDA. When people stop to do that, then you can be confident this is the time for you to nice dove into the market and to really buy as much as you can, because this is going to be the bottom. As long as there will be a lot of people speculating and buying all these leverage instruments, then there is a lot of downside potential again. I'm not saying that it's going to be a downside, a massive downside from the level we are today. Could be that tomorrow is going to be extremely volatile, and then there will be the inflation data. There will be also a lot of volatility, but it doesn't mean that it's going to go down by another 10%. Again, earnings are good. The employment figures are not bad. Unemployment rate is at 4.1 from 4.0. I mean, nothing really dramatic from that. You see, so you shouldn't really panic. And if it goes down by minus 20%, and that means another 10% from where we are today, then you should be thankful. You're gonna buy cheaper the stock that you want, or maybe top up your existing index holding or whatsoever, and then you have to wait the long-term game, you know. But there will be a massive opportunity to buy stocks at massive discount from what it was last year, you know. But will it happen? I'm not so sure. And if it happens, thank you so much. I'm gonna suffer for sure. I don't like to see red in my portfolio. Everybody doesn't like to see red. But I'm going to hold my nerves. I'm going to control my emotion. Controlling your emotion, this is the power, you know. If you want to become powerful, if you want to become successful, and the real power is controlling your emotion. Don't feel guilty that you panicking, or you feel fearful, or you feel sad, or you feel like a bit angry that you're, and then you're berating yourself that you've been stupid to do this and this. Don't be ashamed of that. Everybody goes through this, you know. But the power is not to act on your fear, and the power is not to act based on your emotion. I know it's easy to say. Myself also, I struggle to do that. But I managed to do it. I managed to do it in my private life. I managed to do it in my love life. I managed to do it in the stock market. And the same with your private life. If you are fearful about anything, that your wife is losing you, or you're going to lose a job, or you're going to do this, you're going to do that, I can tell you, you're not going to be a winner. You have to be fearless, you know. Not stupid. You have just to be fearless, and you have to control your emotion. And from the control of your emotion, you're going to become powerful. This is the true power of a man, to control his emotion. So again, I hope that you will listen to this message to the end, and you will learn from these lessons. And then I will probably catch up with you after the market close, and we're going to do a market recap for Monday, and we're going to look at economic indicators and all the usual stuff. So please, if you really like this video, you want to learn how to invest in the market, and you want to learn a lot of things about my experience in the market, please subscribe to this channel and hit the like button and make a comment. I know it's a lot to ask. Sorry. I know it's a lot to ask, but it doesn't take so much. I mean, It's the only thing you can do to help me to get more views on the channel. It's very difficult to start a new channel, so but if you help me, this message can reach a lot of young investor, or maybe not so young investor, but that actually do the same mistake over and over again. Okay, so thanks so much to subscribe and to like and to leave a comment. See you. Bye.